Here's what I see on Broadcom right now. The stock just made a massive run from $290 all the way up to $440 in a matter of weeks. That kind of vertical move always ends the same way, a pullback. Always. And right now, every signal I look at is telling me the same thing. This stock is turning. I'm playing the downside. I'm selling a call option on Broadcom with a strike at $420 expiring in 30 to 45 days. I'm collecting $1,500 to $1,800 in premium on this trade. My target on the stock is $350, and if Broadcom stays below 420 at expiration, I keep every single dollar of that premium. That's the trade. Now let me walk you through the 3 reasons this setup is so clean, and then I'll show you exactly how to put it on in interactive brokers. First signal, the false breakout. Look at this chart. Broadcom broke above the $412 resistance level that has been holding for months. It touched 440 and then immediately came back down and is now sitting right back at 412. That move above resistance was a bull trap. It sucked in late buyers and now those buyers are underwater. When a breakout fails like this, the reversal is usually fast and sharp. Second signal, the extension from the moving average. When Broadcom ran from 290 to 440, it went completely parabolic above its moving average. That blue curved line on the chart, the price was miles above it. Stocks always come back to their moving average. It's like gravity. The further they stretch, the harder the snapback. Right now, that moving average is sitting well below the current price, and the price is already starting to fall back toward it. Third signal, and this is the one that sealed it for me, the RSI. Look at the bottom of the chart. The RSI went above 80 during that big April run. Above 80 means the stock is overbought, pushed too hard, too fast, by too many people buying at the same time. And now the RSI has dropped back down to 63 and it's still falling. The signal line is at 52. This is the textbook signal that momentum has shifted. The buyers have exhausted themselves. The sellers are in control now. 3 signals all pointing in the same direction. That's when you act. I'm selling a call option on Broadcom, ticker AVGO, with a strike price of $420 expiring in 30 to 45 days. The premium I collect on this trade is approximately $15 to $18 per share. Since one option contract represents 100 shares, that's $1,500 to $1,800 collected upfront the moment I execute this trade. My maximum profit is that full premium, $1,800. That happens if Broadcom is below $420 at expiration. Given my target of $350, I expect to collect the full amount. My target on the stock is $350. Here's why I picked that level. The major support on the chart sits at $323. That's the floor where buyers have historically come in strong. The current price is $412. The midpoint between those two levels is around $367. I'm targeting $350 because that's where the price consolidated heavily back in March before the big run started. That's a natural landing zone for a correction of this size. That's a 15% move to the downside. On a stock that just made a 50% move to the upside in a few weeks, a 15% correction is not aggressive at all. It's conservative. Now, what's my risk on this trade? If Broadcom somehow breaks out above 420 and keeps going, my sold call starts losing money. To protect against that, I buy a call at $440 as a hedge, turning this into a bear call spread. That caps my maximum loss at around $500 to $700 depending on the premium. So I'm risking $500 to $700 to make $1,500 to $1,800. That's a risk-reward ratio of roughly 2.5 to 1 in my favor. I'll take that all day. Now let me show you how to put this on in interactive brokers. This is where most people get lost. The theory makes sense, but the execution feels complicated. It's not. Here's exactly what you do. Open your interactive brokers account and go to the trader workstation, or you can do this directly on the mobile app if you prefer. In the search bar at the top, type AVGO and select Broadcom Inc. from the dropdown. Once you are on the AVGO page, click on Options in the left panel. This opens the option chain. You'll see a list of expiration dates. Scroll to find the one that's 30 to 45 days out from today. Click on it to expand the chain. You'll see two columns. Calls on the left, puts on the right. You want the calls column. Find the row with the 420 strike price. You'll see a bid price and an ask price next to it. The bid is what you'll receive when you sell. That's your premium. Right now that should be sitting around $15 to $18. Right-click on that row and select Sell. A ticket will appear at the bottom of your screen. Set the quantity to one contract to start, set the order type to limit, and enter a limit price at the midpoint between the bid and the ask. Don't just hit market, set the expiration of your order today. Review everything one more time, make sure you're selling the 420 code, the right expiration date, quantity 1, limit order, and hit submit. You'll see a confirmation pop up, click OK. The trade is live, you've just collected your premium. From this point on, every day that passes without Broadcom going above 420 is money working for you. If you want to add the hedging, the 440 call purchase to cap your risk, repeat the same process, but this time right-click the 440 strike and select buy instead of sell. That turns your position into a bear call spread and limits your downside exposure. Now you manage the position. You don't need to babysit this trade every hour. Set a price alert on AVGO at $425. If it gets there, reassess. Otherwise, let the trade breathe. If Broadcom drops toward 350 as I expect, your sold call will lose most of its value quickly. At that point, you can buy it back for a fraction of what you sold it for and lock in your profit early. You don't have to wait until expiration to close. If Broadcom moves sideways and just stays under 420, you win at expiration. Time decay works in your favor every single day when you're the seller. Look, I've been watching this chart all week. A forced breakout, the RSI rolling over, the price extended way above the moving average. This is one of the cleanest setups I've seen in months on a stock this size. Broadcom is a great company, but great companies correct too, especially after moves like this one. And when they do, you want to be positioned on the right side. I'm in this trade. I've shown you exactly why and exactly how to execute it. Now it's your turn to decide if it fits your own strategy. Now look, yes, I can lose on this trade. Every trade carries risk, and I'm not going to pretend otherwise. If Broadcom ignores all the signals and breaks out to 450, 460, I'm losing money on the sold call. That's the reality of trading. No setup is a guarantee. But here's the thing, I'm risking $500 to $700 to make $1,500 to $1,800. Even if I'm wrong 2 times out of 5 on setups like this, I'm still profitable over time. That's what risk-reward means in practice. It's not about being right every single time, it's about making sure that when you're right, you make more than you lose when you're wrong. And on this trade, the math is firmly in my favor. That's why I'm taking it. This is not financial advice. I'm sharing my own trade, my own analysis, my own reasoning. You are fully responsible for your own decisions. Always manage your risk, always size your positions appropriately, and never trade with money you can't afford to lose. If you found this breakdown useful, subscribe, hit that bell. We do this every week. Real trades, real charts, real execution. No noise, no hype, just setups that make sense. You don't want to miss the next one. See you in the next video.